It's been a big week for the bond markets, with the Federal Reserve cutting interest rates for the second time since July, and the 2-year, 10-year spread almost inverting again. Join us now to talk about some of the biggest opportunities in fixed income. Brian Rehling, he is co-head of global fixed income strategy at the Wells Fargo Investment Institute. Have we seen the lows in rates, Brian, in your view?
Oh, I don't think so. I think over time the trend is pretty clear, and rates eventually will head lower. Maybe in the near term, not quite as fast, but lower rates are in our future, I'm quite sure.
That doesn't sound like it's good news for everything else, does it?
Well, I don't know. I mean, low rates, as long as they're not associated with a recession, can actually be positive for a lot of risk assets. I mean, that's essentially what the Fed's doing, right? These low rates, they're kind of forcing investors into kind of riskier choices.
So it's not, at this point, a global slowdown that brings us to new lows. It's just all the different reasons that we use to explain negative rates in Europe and elsewhere. It's inflation. It's a secular change in the whole interest rate structure. It doesn't mean that we're going to have a global recession or at least a very weak growth.
Yeah, absolutely. Right. So I think of it as, you think of like a recession, the conditions are favorable, right? So, but we still need a spark. We still need something to kind of mix all those ingredients together to cause a recession. And then clearly you would get extremely low rates here in the U.S. But absent that, yeah, I think we can kind of continue along with some decent growth here in the U.S. But I think rates clearly globally and also here in the U.S. are kind of destined to stay relatively low.
Well, nobody's ever going to retire again then, Brian, unless you retire and go into equity. You're going to keep following this horrible sector of the financial markets. What should we do? To buy some corporates, some junk? How do we get yield at this point? Private equity?
Right. Well, I do think you have to look for some of those alternatives, as you see over on the equity side, the higher dividend yielding. But even within fixed income, there are some opportunities. I think you have to be selective. One area we've been advocating for clients for most of the year, and they become more expensive as of late, but preferred securities are an example where you can have some high quality names, but they're subordinate. And you get some pretty decent yield. And if you don't think rates are going up anytime soon, you're probably not too worried about the very long dated or even perpetual maturities there. So, yields there, 5.5% or so. And that asset class is up over 14% this year.
Do you ever see equities decoupling from the bond market? You're going to view this half full, that there is no alternative, so equities continue going higher. Not that there's a problem globally with some type of malaise. This is a positive thing for equities. Yeah, I would think eventually you'd decouple if rates went down so much.
Well, I guess it depends why rates go down and how quickly they go down. So, yeah, there's no question that if growth slows meaningfully, you're not going to want to be in equities during that period. In fact, even at these low rates, long-dated, high-quality fixed income, they're going to have really strong returns in that type of environment.
Like Chuck Prince. That goes down in history. We'll keep dancing until everybody's got to find a chair, and there's like 3 left.